All right, hello everybody. Today I'm going to be presenting P7-1A. So for part A, we're doing the absorption costing income statement. So absorption costing is attaching all the manufacturing costs to the product. So for the income statement, we have the sales at $2 million, 800,000. The beginning inventory was zero. The direct labor or the direct material was 880,000. Direct labor was 720,000. Manufacturing overhead was 864,000, and then the ending inventory was 308,000. So how we found the manufacturing overhead is we did 544,000 plus $320,000 to get the manufacturing overhead, and then for the ending inventory, we did B5 plus B6 plus B7. And then we multiplied that by 10,000 over 80,000. And then to find the cost of goods sold, right here at $2 million, $156,000, we did B4, which is 0, plus B5, plus B6, plus B7, minus B8, which was the ending inventory. The gross profit was just C2 minus C9, so the $2.8 million minus $2.156 million. And then the operating expenses were just $175,000 plus $240,000. And then the final net income, which was a loss, was C10 minus C11. And then we're going to go on to part 2. And so then instead of absorption cost income statement, we did variable costing income statement. So variable costing is only variable manufacturing costs are capitalized as inventory. So for the sales, we have the same number. Beginning inventory is still also 0. Direct material is still the same. Direct labor is still the same. So is variable manufacturing overhead. But then the ending inventory is different. We just did B19. We just did these 3 numbers. So B24, B25, B26 times 1,000 over, or 10,000 over 80,000. And then the variable cost of goods sold was just the same number. So B23, B24, B25, B26, and then minus B27. And then for the contribution margin, we did This is the number that we got, 749,000. And then the total fixed cost is going to be 560,000. So we just added the manufacturing overhead and the operating expense. And then the net income was also $189,000. And so those are parts A and B. And then part C was the decision making in profit or loss on the special order. The income statement based on variable costing will be presenting the most relevant data for deciding whether to accept a special one-time order for 1,000 units for $25. The calculation of profit divided by loss on special order based on variable costing. So the total variable cost for cost of goods sold, which is 70,000 units, is $1,876,000 plus $175,000, which comes out to $2.0151 million. Therefore, the costing of 1,000 units, $2,051,000 times 1,000 over 70,000 is $29,000 and $29,300. So the profit or the loss on the special order of 1,000 units, we have the sales price of 1,000 units minus the costing of 1,000 units. So we do $1,000 times 25, or 1,000 units times $25 minus $29,300, and this comes out to a loss of $4,300. And then if the ending inventory is to be destroyed by fire, absorption costing would be appropriate because it would be like a basis for filing an insurance claim for the lost inventory. Absorption costing approach would also work because the cost should include a reasonable portion of fixed manufacturing costs. So that is my presentation of P7-1A. Thank you very much.